Hi everyone, welcome to my conference call. It's really great to see everyone again. So if there's any tech enthusiasts in the audience today, you'll know that it's currently the Web Summit and eToro has a big booth there. If you want to see what's going on there, they've been posting it on their Twitter and Instagram. I was supposed to go out there and we had planned to present from there and make it really fun. But unfortunately, I wasn't able to travel because I wasn't able to get a visa. But I am joining you today from Central Oxford. I'm actually in the Vincent Club in the heart of Oxford, which is an exclusive members only club. So we've tried to make it a bit more interesting. So with that, let me get going with the presentation today. As always, for those of you who have been in one of my conference calls before, please feel free to put any questions in the chat. I want this to be as interactive as possible. I know it's quite a big group. I will keep an eye on the chat if there's anything which pops up, which I think is relevant to address as I'm going along. Otherwise, there will be time at the end for questions. I have tried to, over the last year, to be as approachable for people to reach out to me. Of course, with the amount of followers and copiers I have, it's not always easy. So I do apologize if I take some time to reply. But you can find my contact details on my website and reach out to me in either Instagram or via the website or whatever platform is convenient for you. Any questions, please feel free to email me. My turnaround time is slightly slow sometimes, but that's just because of the volume of questions that I get. And I do try and prioritize my time for research and my investing above everything else first. So that will always be my priority. I love to start with a slide. I'm sorry if you've seen it before, but I've had an absolute phenomenal year with just the amount of media coverage that I've been able to get. And it's always nice to reflect when we have this meeting on, yeah, how much my portfolio has grown and kind of where we're at. So when we met last time, I think my AUM was just over 40 million. At the moment, I'm quite healthily over 50 million. My copiers are still the same, so that growth is mostly because people are adding more to their portfolio, and also because, of course, the portfolio itself is growing. What I'm really excited about this is my current average copier duration is 220 days, which I think really speaks a lot about the maturation of social trading community in general. As you all know, this is a long-term portfolio, and I do encourage people to copy me for as long as possible, but I know that's not always possible for people. Things happen. Just being able to see my copier duration steadily going up, I think is really heartwarming because it shows that people are obviously satisfied with the portfolio, but also that they understand the value of staying in the game for the long term. And then I probably have to thank you all firstly for your patience. As you probably would have heard, a lot of the other popular investors have talked about the new educational requirements and the exams that a lot of us had to write before the end of October. That did end up taking a lot more time than I anticipated. So I do apologize that I've been fairly quiet or fairly slow at starting new initiatives, like being more active on YouTube. But yeah, that's just because all my extra time has been going into the studying. But I'm happy that actually just before I logged on, I got the prompt from eToro to say that it's all clear. I have my certificate in investment management, and it's actually been quite a useful exercise. I think all of the PIs have said that, and taken the last month off just to take a bit of a break from that. But I definitely have some ideas of things that I would do for next year. So all of you probably already know, and that's why you're investing in this portfolio, but I thought I would just kind of stack up our stats compared to some of the big names out there. And I'm taking a bit of a leaf from Jeppe on this. In terms of our average annual return, I think the combination of annual return and Sharpe ratio of this portfolio is really unlike any other that you can find, just in terms of getting a good return and having a strong Sharpe ratio. As you'll see, usually when people tend to get a better return, their Sharpe ratio goes down. And so for those who are new, Sharpe ratio is your return that you get for every dollar that you're investing in the portfolio. And so usually having a Sharpe ratio over 1 is quite preferable. eToro has done a really great job in terms of allowing people to compare those stats across the different PIs. So along with obviously talking about the portfolio today, I think it's quite important that I always encourage my copiers to copy other portfolios as well, just to diversify your portfolio. I mean, it's like having all your eggs in one basket. You're not just going to buy one stock, you're not just going to buy one ETF. So you'll probably have a couple of popular investors in your basket. And so I think the fact sheets, which is able to give you all the statistics down here, is a really great resource, which all the PIs should be sharing now. So do familiarize yourself with it and make sure that you are choosing PIs that do align with your goals. Apologies for those who have seen this before, but I will just give a brief introduction about myself for those who are new to me. I think because of the scale of the amount of people I have who are copying me, it's not always that I get to introduce myself on like personally to everyone. I'm Heloïse Greeff. I'm a serial nerd. I studied my first degrees in engineering in my hometown at the University of Cape Town before coming to the University of Oxford as a Rhodes Scholar. And when I got my PhD, not much changed for me. I just stayed Heloise to all my friends and colleagues. But you all know Pepper now, and that's my dog. She became Dr. Pepper in our neighborhood and with our friends. So she has been enjoying the fruits of my labor. Before I joined eToro, during my time at eToro, I was involved in being one of the co-inventors of the Oxford Smart Hand Pump, which was really a project related to creating novel data streams on which we could apply machine learning in order to give people access to sustainable water. And I spent 4 or 5 years working on this project and spent nearly 2 years living in a remote village off the coast of Kenya, just north of the Tanzanian border. And yeah, I learned a lot about implementing AI into the real world, which isn't always as simple as you think. And of course, it wasn't all hard work. I also participated in the annual Shimba Hills Olympics, where I came absolutely stone last in the bike race. But yeah, that's not one of my best talents. So I got quite a reputation for my work in that area and was then approached by a startup who was working across East Africa using Internet of Things to basically finance assets, specifically solar panels, but later also smartphones and giving loans to people in rural communities who are basically unbanked. They don't have bank accounts, so there's no way that the bank could give them a loan to buy these assets because they're just not, they don't have any credit history. And so I helped them out with, again, designing a pipeline for data which they could use to do better credit scoring on these customers, and have then since moved on to working on wearable sensors and predicting patient deterioration or human kind of physiology from that. And a lot of my awards are related to my work in AI. So what am I currently doing? I'm one of the few PIs, elite pros at least, who I'm not a full-time popular investor, so I'm very candid about that. And I work as a research fellow at a machine learning, clinical machine learning lab in Oxford, where I'm leading our team on global health. So specifically using wearables to monitor patients. Because of that, I'm also part of the executive board for an Australian startup called My Raphael. And because I have a lot of experience of working in industry and translating research into industry, I'm on the divisional fellow for enterprise and innovation. So basically trying to help other research get into the real world. So my financial journey began really, really early. When I was really young, my mom would ask us to submit budgets for our monthly kind of pocket money. And based on that, we would, get our pocket money or not get our pocket money if we were overspending or underspending. It was really annoying, but it was a really valuable lesson in the value of money. So I first started investing in the stock market in 2009. And finally, in 2016, was either brave or naive enough to think that I could do better than the broker or the fund manager who I was investing through, and joined eToro. It was quite a steep learning curve in the beginning. Like many others, I was really impatient. I was day trading oil, and so it was a steep downward curve for my portfolio. But thankfully, I kept persevering. I kept redefining my strategy, and finally also wrote a proprietary machine learning algorithm that helps with my technical analysis, which I've been using for the last 4.5, 5 years. And I became a popular investor in 2019. I always get asked the question, how different is it for having, so many copiers? And I really think the most important thing which has changed, there hasn't been a lot that has changed in the way I invest or the decisions I make. Of course, one thing which has had to change is the fact that I had to be a lot better at communicating my decisions to my copiers and my followers. And that I think has really made me a lot better at investing, because I've had to make sure that every decision I make is really, the risk of each is calculated. So I'm currently one of eToro's most copied popular investors, and there's a lot of exciting things happening. In the last few months, I have recruited an assistant who is going to start working with me. So I've now formalized a lot of the processes which happens in the trading. Of course, a lot of it still comes down to me making the final decision. But yeah, I look forward to working with my research assistant to just kind of expand a little bit, I think, beyond this portfolio as well. So another thing which I have mentioned, if you did hear me on the Copy Traders Club, is we have been kind of experimenting with a bit more of a risk managed portfolio, which has a slightly higher risk score, but also gives higher returns on my partner's account, which is the Rebro 889. And that's been going for almost a year now. So we're really excited about how that portfolio is going, but I'll keep you updated on that. So in terms of the portfolio for rubymza, which is the one that you all are copying, it's really a long-term portfolio which focuses on compounded growth. You'll often see me taking out profit and reinvesting it, and this is just part of making sure that you get that compounded growth. I tend to keep the risk management really low to reduce the volatility, and that's something that I'm really proud of. I don't think there are a lot of portfolios out there which can give the same return. I have a lifetime maximum drawdown of 16%. So I often get asked what should I set my stop loss at. I don't typically advise that you set a stop loss, because as I said, in 5 years, my maximum drawdown has been 16%, which is really minimal for a portfolio like this. I use fundamental analysis to look at, the current economic environment. And then, as I mentioned, I also have my bespoke machine learning algorithms, which helps with the technical analysis. So one of the aims which the eToro platform is great for is to make sure that I have zero or low fees, which can really compound over a long time. So that's something really important to look out for. And then finally, I also like to use natural language processing to look out for some patterns in what is called the hive mind. So that's really just long-term mega trends that are happening on social media that people are talking about, or that is generally coming out in the news. So when we met in July, I gave a kind of year-to-date review of the year so far. And actually, not much has changed, but there are a few important bits that I should clarify about that, because I think we've had a really unusual year and we are in a really unusual time. So we continue to see really strong economic growth in some of the major economies. Again, this quarter, we've seen really strong corporate earnings like we did in July, which is really driving the market and has said to ease a lot of the kind of inflation fears that we have seen. Of course, the interest rates around the world continue to be quite low, which I think to a large extent is driving people to be a bit more experimental in where they try and get those good returns. And I say this with some cautious optimism because I think I'll talk later about what my view is on a potential market correction, because again, I get asked that question a lot as well. We did experience the strongest first half of this year in 9 years. I think we were at 16%, and it's the second best in 23 years. Touch wood, we're currently in November, but it looks like we are on track to, end another year in double digits, both for this portfolio, but also for the stock market generally. And that only happened twice in the last 80 years. So while we should be enjoying a lot of the growth which is going on, I do continue to highlight this because it should be in the front of our minds if we think about the future and what could potentially come, because there might be a correction. I'll talk about that later. The other thing which continues to be unusual is the seasonality which we usually see. So things which kind of come at the same time each year has just not been the same. And so the stock market generally is in a lot of disarray and it is creating a lot of worry. But we did see a strong rebound in October, despite the kind of very choppy September that we had. So the stock market was up 5.7%. I think our portfolio was up just over 7%. And some of the major events which is happening, of course, the vaccine rollouts continue, although the questions around it may just change from, whether countries should open or not to now, some countries like the UK have already started with their top-up boosters. In the UK specifically, and I mentioned this because I did introduce more and more UK stocks into the portfolio, has been the release of the UK from the EU, which in the last few months, we have seen a lot of supply chain disruptions and a lot of, kind of the tourism industry and the hospitality industry generally are struggling to fill staff, which they would have generally relied on from Europe. And then same is the case with China. I think we talked about this last time. LinkedIn and some large US tech companies are starting to pull out of China. So there's definitely a lot of uncertainty about the Chinese market. And again, when I'm talking about the future, I will address some of my views on these. So in terms of the portfolio composition, I did not include the previous compositions, but I will talk through them if you don't recall them or you weren't able to make the last call. Overall, our sector breakdown in the portfolio still looks very much the same, although there has been quite a lot of movement within the portfolio. There are 10 stocks that have been removed. Most notably would be Tesla and Tata. So we no longer have any exposure at the moment to the automotive industry. And that was just because I'm currently favoring a bit larger exposure to the semiconductors and also a shift to consumer goods, which cyclical goods tend to do quite well in economic recovery. And so that was a category that we were previously lacking. Also, you would notice that there is a cash buffer, which is slightly larger than what we were holding before. And so Some of the consumer goods stocks that were added was L'Oreal, LVMH. Overall, I think I've slightly increased the exposure to financials. Both financials and the consumer goods are expected to do quite well in the economic recovery. This used to be a predominantly tech and health portfolio, but yeah, in the last year, it has definitely diversified a lot more to make sure that we can, gain the most from the economic recovery as the world is changing around us, really. In terms of our geographic breakdown, we have slightly increased the exposure to the US market, which, if you recall, last time we met, it was at 67%. So not a lot, but definitely a bit more. I think this would be where I would cap it, just in terms to make sure that we have enough exposure to other markets. As I mentioned, this was previously almost exclusively US exposure, but again, over the last 18 months with the diversification, which I included, that also included geographic diversification. So a lot of the shift has come from the UK stocks, which were taken out, which was put into US stocks. And that's just because of what I've mentioned about, in addition to recovering from the pandemic, the UK has also been experiencing a lot of supply chain bottlenecks and other effects which are related to Brexit, which are hopefully short term, because we've seen the digital and the financial services have had a lot more smoother transition than some of the other sectors. So those are the ones which I continue to keep an eye on. In terms of our size breakdown, again, this has stayed roughly consistent, except for the slight increase to large caps, and the trim again came mostly from the mid caps, purely just because I found the large caps a lot more stable, especially with the market-wide instability in September. So yeah, the increase mostly comes from the mid caps, which were trimmed down, but then also the larger cash buffer, which we're currently holding, which we could anticipate to go up to 20% in the next few months. So you'll also notice, as I mentioned, the increase in the cash holding, which was 7% last quarter. It's gradually increased to 11%. The highest I've ever gone up to is 20%. I always get the question, why aren't you using all of the money that we've invested? And it's just because cash is a really important buffer against volatility. It just gives you the opportunity to go back in if there is any correction in the markets, rather than suddenly like being fully invested. In terms of our portfolio performance, this was it was really nice for me to make this chart, because yeah, you need a lot of data points to make it, and one data point is 1 year. So I now have almost full 5 years on the eToro platform, and I'm really, really proud of how the portfolio has consistently performed. Our benchmark, the S&P 500, over the 5 years, the S&P has delivered just over 80%, whereas our portfolio delivered just over 130%, so 1.5 times more. And again, if you look at the risk score, the drawdown, and the general standard deviation within the portfolio, I think it's really phenomenal return given all of the other stability within the portfolio. So I'm always wishing that I could invest more of my own money in the portfolio. But yeah, that would make it difficult for some of the positions to open. In terms of my 2021 outlook, but also going into 2022, because we are quite close to the end of the year. First theme, again, would be the vaccine rollouts. As I mentioned, some countries are moving on to the top-ups, but then we're also having to have the difficult conversation about equitable distribution of the vaccines, because that would really be the only way for us to ensure that the whole world can open up and we can go back to the globalization which we saw before the pandemic. we continue to see strong, economic recovery as economies around the world continue to reopen. The US Feds are supposed to announce the tapering of its $120 billion a month bond purchases. And tomorrow we're expecting the Bank of England to be one of the first top central banks to actually increase the interest rates, despite the ongoing strong support for low interest rates and fiscal spending. So I would say that's one of the major risks going forward towards the end of the year is the Fed policy tightening, although it's not an unexpected one. I think if you've been following my posts, you'll know that, we've been talking about the Fed's tightening their spending policy for a long time now. It's one of those things which we knew it's coming. The question was just when and how it will happen. In terms of cryptos, I didn't specifically talk about them when I talked about the portfolio breakdown, but they have kind of come back in the portfolio again as we're currently seeing a bit of a crypto bull run. If you recall, in the beginning of the year, our exposure was up to about 10% crypto, and then massively trimmed it down when the cryptos kind of stalled for a while to less than 5%. Today we're at about 6%. It's always a tricky one because the risk adjusted returns of those can be quite good over the long term, and they have been traditionally been quite uncorrelated to the stock market. But yeah, Bitcoin has largely, I think, stalled after its recent all-time high, although there's still a lot of expectations for Ethereum to set a new price record. And that's kind of how I'm adjusting the portfolio. But one thing which has been really promising, which we've been seeing, is that Bitcoin has had a lot more inflation hedge acceptance, which is something that I've been talking about for almost a year now, but it's not quite responded as such. And this really comes, I guess, because of like multiple reasons. But one is also the kind of lag in gold. So gold, as you recall, gold was usually used as a hedge against inflation. And gold has just not delivered as we expected in the last few months. And the World Gold Council actually reported that there's been 7% less demand for gold in Q3, which is really interesting given how conscious and obsessed the market currently is with inflation, that investors just don't seem to have the same appetite for gold, and that is kind of shifting towards Bitcoin, which is really great because we have some Bitcoin in the portfolio and we've been anticipating this for some time. Is there going to be a market correction which is imminent? Yeah, depending on which news source you read, I guess there are multiple kind of opinions out there, so I can only give my own. I don't believe that we'll see a market correction to the same extent to the one which we saw March last year, not in the immediate future. eToro's market analyst team recently projected a target for the S&P 500 to be up 11% in 2022, which I think is a bit generous, but not unreasonable. I'd probably pitch it at single figures. So that's saying that we still do anticipate positive growth going into next year. But at the same time, yeah, I'm saying that we should expect lower returns going forward and a lot of increased volatility, simply because I just think market corrections usually happen when nobody's watching or nobody's expecting them. And there's currently just so much, everybody's on this topic. The Feds can't even sneeze without the media and investors being on their backs. So it's very unlikely that we would see that, scale of market correction, I believe, in the short-term future. However, having said that, I think it would be silly of me not to prepare for multiple scenarios because, yeah, I don't think history doesn't always repeat itself, and we don't want to be naive about the future. And that is one of the reasons why I've been slightly increasing the cash reserve taking profits out more regularly than I would have, and shifting to a bit of cyclical stocks, which wasn't previously in the portfolio. Those tend to do quite well. So taking a number of steps to make sure that we would be prepared for either scenario. And yeah, just then remaining disciplined and remaining patient in that. I think that is a approach which worked really well for this portfolio last year when we had the correction in March, despite it being, back then nobody was anticipating it or predicting it. And so I think that has worked quite well in very tough times. And so it just seems sensible to keep going with it. So in terms of longer term future trends, I've been looking out for some of the changing patterns. So been talking about, how as remote working continues, we're seeing a lot of countries looking inward for stimulating their own economies. So bringing production back onto local soil. We're definitely seeing that in the UK and the US. But at the same time, we're seeing digital work moving to more remote work. So there's this kind of inverse thing happening where people are more global in terms of the companies they work for, but a lot of things are coming back to local soil. And these working patterns are creating kind of interesting behaviors in humans, specifically how we relate to recreation. We've been seeing a massive spending on luxury goods, which traditionally you would expect not to happen when there's a lot of uncertainty in the market. And similarly with the gaming industry. So both those have been included in small amounts in the portfolio. Of course, we currently have the COP26 happening in Glasgow. And so, yeah, a lot of countries are signing up for going net zero on different timeframes. I think 2050 is like what I've heard about some of them. And so it'll be really interesting to see what happens by the end of this week, and keeping a close eye on that. And finally, globally, the Asia international relations has been the one that has been quite interesting, because it's not just been the US that has been hitting highs on its markets. If you've actually been following, India is currently the second best performing market, up 30% this year. We have some of the India ETF, we had that at one point, mostly just because of their lower COVID numbers and a lot of reallocation from China into India. And then conversely, China has been second worst performing market. So this means that there is some valuation premium on India at the moment. And conversely, as the tech crackdown continues in China and the economic slowdown, it could mean that those stocks are quite well priced, as they would be at a discount. So we don't currently have a lot of exposure to either of those in the portfolio. But I do have a bit of both of them, just to make sure that we are prepared either way. And then just a final few notes. Last time I mentioned that I am really excited about being involved in a bit more financial education initiatives. The first being eToro's own Invest with Her, which is focusing on including, while supporting more female popular investors to kind of climb through the ranks. And so I'll be giving a workshop on that in February. I've also joined forces with a community called Juno, who is giving technical workshops on investing to women. And I'll be hosting the more practical nuts and bolts side of, oh, you understand all the technical bits, like how do you kind of practically get into it? So I'll share those invites with all of you. If you have anybody in your own direct kind of network who you think could benefit from them, please do invite them along. Just a second note on the mailing list. So I started a mailing list maybe a few months ago now. Up to now, the mailing list has been quite consistent with my weekly post that has been going out on eToro. But I do foresee that at some point, those two will merge slightly, where I have events only for the mailing list, just because my community is so big and I do want to have more of these intimate interactions with some of my copiers, and it's just not possible to do that on social media and other kind of platforms. So I do want to give as much time as I can. It's a bit difficult to discern because I obviously don't know my copiers personally, because eToro doesn't disclose that information. So I'm trying to find a way to create a channel to have those intimate discussions. And so I would like to remind you to sign up for the mailing list. The link below will have the place to sign up. And yeah, just if you missed the discussion on the monthly deposits, you'll know that I was doing monthly deposits before, but currently I've stopped doing that because it's just too difficult to make sure that everyone is able to stay on track with that, which means some people's portfolios get out of sync. And so currently I'm just sending a monthly reminder because I personally think it's a really good habit to do. So yeah, that's just my final few notes.